Most people ignore these tax-advantaged accounts and leave thousands on the table. Here's what you're missing. Everyone knows about 401ks and IRAs, but there are lesser-known accounts that offer massive tax benefits, flexibility, and wealth-building potential. Health savings accounts, 529 plans, SEP IRAs, solo 401ks, and donor-advised funds can save you thousands in taxes while accelerating your wealth. Today, I'm breaking down the accounts most people overlook, who they're for, how they work, and how to use them strategically to build and protect generational wealth. Why tax-advantaged accounts matter. Taxes are one of your biggest expenses. If you're in the 22% tax bracket and you earn $70,000 per year, you're paying over $15,000 in federal income tax alone. Add state taxes, payroll taxes, and you're losing 20 to 30% of your income. Tax-advantaged accounts reduce your taxable income, defer taxes on growth, or eliminate taxes entirely on withdrawals. Over decades, this saves tens or hundreds of thousands of dollars. The wealthy use these accounts aggressively. The middle class often ignores them or doesn't know they exist. Account 1. Health Savings Account, HSA. The HSA is the most underrated account in personal finance. It's the only account with a triple tax advantage. How it works. An HSA is available if you have a high-deductible health insurance plan, HDHP. You contribute pre-tax dollars, the money grows tax-free, and withdrawals for qualified medical expenses are tax-free. Triple tax advantage. Tax deduction on contributions. If you contribute $5,000, that's $5,000 less in taxable income. Tax-free growth. Your HSA can be invested in stocks, bonds, or mutual funds. All gains are tax-free. Tax-free withdrawals. If you use the money for qualified medical expenses, you never pay taxes on it. Contribution limits for 2024. Individual, $4,150. Family, $8,300. Age 55 plus. Additional $1,000 catch-up. Why it's powerful. Most people use HSAs to pay current medical bills. That's fine, but it's not optimal. The smarter strategy is to pay medical expenses out of pocket and let your HSA grow like a retirement account. After age 65, you can withdraw from your HSA for any reason without penalty, though you'll pay taxes on non-medical withdrawals, like a traditional IRA. But if you use it for medical expenses, which you'll have in retirement, it's completely tax-free. Who should use it? Anyone with a high-deductible health plan who wants to reduce taxes and build wealth. Account 2. 529 College Savings Plan. A 529 plan is a tax-advantaged account designed to save for education expenses. How it works. You contribute after-tax dollars, the money grows tax-free, and withdrawals for qualified education expenses, tuition, books, room and board are tax-free. Contribution limits. No annual federal limit, but contributions above the gift tax exclusion, about $18,000 per year as of 2024, may trigger gift taxes. Lifetime limits vary by state, often $300,000 to $500,000 per beneficiary. Why it's powerful. 529 plans grow tax-free and can be used for college, graduate school, trade schools, and even K-12 private school tuition, up to $10,000 per year. If your child doesn't use all the funds, you can change the beneficiary to another family member, sibling, cousin, even yourself if you go back to school. Some states offer tax deductions or credits for 529 contributions, giving you an upfront tax benefit plus tax-free growth. Who should use it? Parents or grandparents saving for a child's education. Even if your kids are young, starting early maximizes compounding. Important note, don't sacrifice your retirement to fund a 529. Your kids can borrow for college. You can't borrow for retirement. Fund your retirement accounts first, then contribute to a 529 if there's room in your budget. For a comprehensive guide to balancing education savings with retirement investing, check out Money, Master the Game by Tony Robbins. Links in the description. Account 3. SEP IRA, Simplified Employee Pension. The SEP IRA is a retirement account for self-employed individuals and small business owners. It allows much higher contribution limits than a traditional IRA. How it works: you contribute pre-tax dollars up to 25% of your net self-employment income, or $66,000 for 2023, whichever is less. Contributions reduce your taxable income. The money grows tax-deferred, and you pay taxes on withdrawals in retirement. Why it's powerful: if you're self-employed or run a side business, a SEP IRA lets you shelter significantly more income than a standard IRA. Example: you earn $100,000 from your side business. You can contribute $25,000 to a SEP IRA, reducing your taxable income to $75,000. That saves you thousands in taxes immediately. Who should use it? Freelancers, consultants, sole proprietors, and anyone with self-employment income who wants to reduce taxes and save aggressively for retirement. Account 4. Solo 401k. A solo 401k, also called an individual 401k, is designed for self-employed individuals with no employees other than a spouse. It offers even higher contribution limits than a SEP IRA. How it works: you contribute as both the employee and the employer. As the employee, you can contribute up to $22,500, or $30,000 if you're 50 or older. As the employer, you can contribute up to 25% of your net income. Combined, you can contribute up to $66,000 per year, or $73,500 if 50 plus. Why it's powerful: solo 401ks allow higher contributions than SEP IRAs for many self-employed people. They also allow Roth contributions, giving you the option for tax-free growth. Who should use it? Self-employed individuals or business owners with no employees who want to maximize retirement contributions and reduce taxable income. Account 5. Donor-Advised Fund, DAF. A donor-advised fund is a charitable giving account that offers immediate tax deductions while giving you flexibility on when and where to donate. How it works: you contribute cash, stocks, or other assets to a DAF and receive an immediate tax deduction for the full fair market value. The money is invested and grows tax-free. You recommend grants to qualified charities over time. Why it's powerful: immediate tax deduction. You get the deduction in the year you contribute, even if you don't distribute the funds to charities until years later. Tax-free growth. Your contributions grow tax-free while sitting in the DAF, increasing the amount you can eventually donate. Avoid capital gains taxes. If you donate appreciated stock instead of cash, you avoid paying capital gains taxes and get a deduction for the full value. Example: you bought stock for $10,000 and it's now worth $50,000. If you sell it, you pay capital gains tax on the $40,000 gain. If you donate the stock to a DAF, you avoid the tax and get a $50,000 deduction. Who should use it? High earners who donate to charity and want to maximize tax efficiency. Also useful if you have a high income year and want to bunch several years of charitable donations into 1 year for a larger deduction. For insights into structuring wealth and tax strategies, read The Intelligent Investor by Benjamin Graham. Links in the description. Account 6. Custodial Roth IRA for kids. A custodial Roth IRA allows minors with earned income to start investing for retirement with massive compounding advantages. How it works: If your child has earned income from a job, babysitting, lawn mowing, or working in your family business, they can contribute to a Roth IRA up to their total earned income or the annual limit, $7,000 as of 2024, whichever is less. Contributions grow tax-free forever, and withdrawals in retirement are tax-free. Why it's powerful: the earlier you start investing, the more time compounding has to work. A 15-year-old who contributes $3,000 per year for 5 years and never adds another dollar could have over $1 million by retirement. Who should use it? Parents who want to teach their kids about investing and give them a massive head start on retirement. How to use these accounts strategically. Step 1. Max out HSA contributions if eligible. Invest the funds and let them grow. Pay medical expenses out of pocket. Step 2. Contribute to your 401k or IRA. At minimum, capture your employer match. Ideally, max out contributions. Step 3. If self-employed, open a SEP IRA or solo 401k. Shelter as much income as possible. Step 4. Fund a 529 plan for kids' education, but only after your retirement is on track. Step 5. Use a donor-advised fund if you're a high earner who gives to charity. Maximize tax efficiency. Step 6. Open custodial Roth IRAs for kids with earned income. Start their wealth-building journey early. The tax savings add up. Let's say you're a family earning $120,000 per year. Here's how these accounts could save you. 401k contributions. $20,000 saves $4,400 in taxes. 22% bracket. HSA contributions. $8,300 saves $1,826 in taxes. 529 state tax deduction. $5,000 saves $250 depending on state. Total annual tax savings. $6, 500 over 30 years. That's almost $200,000 in tax savings. Money that stays invested and compounds. Your next move: review which accounts you're eligible for. Are you using an HSA? Do you have self-employment income that qualifies for a SEP IRA or solo 401k? Are you saving for your kids' education? Open the accounts you're missing. Fund them consistently. Maximize your tax advantages. Taxes are your largest expense. These accounts are legal, powerful tools to reduce that expense and build wealth faster. That's wealth mode. If this video was helpful, please click the subscribe button and then like and share with your family and friends.